people love to hire their kids because it's like straight up saving money. You reduce your income, the kids get paid to do work. I do that paid to get work thing because a lot of people are abusing that. They're saying that their child works for them, but in reality, the child is not really working for them or at all. But they go, they make the records, they create this W-2. If they're under the age of 18, meaning like 17 or under, you don't have to do any with Social Security. If they're getting paid from the right type of entity, which means it's not a corporation, so an S Corp, a C Corp. If you have one of those businesses, you can pay the kids, but you'll have to pay Social Security on those wages. So what they do is they have an LLC or a sole proprietor, Schedule C, and they'll go ahead and they'll pay their child from those. And then if it's owned by the parent, or if it's a multi-member LLC partnership, it has to be owned by both parents, then you can pay the kid under 18 and then not have any Social Security tax. And if you pay the kid, the hack is if you pay the kid under the standard deduction of that year, so it's like $15,000 basically, that kid doesn't have to file their own 1040 because that's the only income, and then W-2, the $15,000 W-2 will be reduced by the standard deduction and have a zero taxable income. So ultimately no taxes can be paid on that, and you're going to get a straight up deduction from your entity. So your entity or your LLC or whatever, let's say you're at a 35% rate, you just save 35% on $15,000. It's sweet money. And then what people do, because they want to start enriching their children, when the child has earned income and they make under that certain amount, they can do a Roth IRA. So that's something you're going to hear all the time, Roth IRA. And what is a Roth IRA? A Roth IRA is basically, you don't get a deduction now, but it grows tax-free, and then on retirement, when the child, who's not a child anymore, takes that money out, it's all tax-free. So if you really have this plan of putting in money in a Roth IRA for anybody, not just a child, if for 20, 30 years it grows, you can have $300,000 at the end of 20 years, and that money can be taken out tax-free. Now, if you take it before the retirement age of 59 and a half, you can't get it tax-free. You'll have to pay tax on the growth, whatever it grew. But if you took it out after 59 and a half, so when the kid or the person becomes 60 years old, you can have $300,000 of completely tax-free money. And if people see what they pay when they have taxable income, that's huge. That's huge. Obviously, if you can somehow get your Roth IRA over the years to be $3 million, $4 million, that's like crazy tax-free money. It's not easy to get to there. I don't know that many people that have a huge Roth IRA, but for 30 years, if every year you put $7,000 into a Roth IRA, it's pretty amazing. And then there's other Roth 401ks. When you actually do business, you can actually do Roth 401ks. So Roth is great. Some people play that. Some people like to save money now because they're at a high rate, and then they hope that there'll be a low tax rate later, so they'll pay later. So they do it through a regular IRA, a regular traditional 401k.